Well, let's get back to the big deal that was just announced. Orient Cement getting gobbled up by the Adani Group. Well, the deal has been done at a valuation of around $113, $114 per ton. Take a look at the stock prices before we get our analyst who's going to join in. Orient Cement, massive delivery-based buying in the last few days. The stock is down 2% now. Just take a look at it. The intraday chart actually should come up for you. And Ambuja Cements, they are paying top dollar for this asset. You know, $115 per ton. That's quite on the higher side. If you look at it. But to help us out with a quick analysis on that front, we have Jyoti Gupta, the Senior Research Analyst, Nirmal Bang Institutional Equities, who joins us. Hi, Jyoti. Good morning. Thanks a lot for joining in. What do you make of this asset? It seems the street clearly sniffed it, so we're not seeing that big positive reaction. But at around $113, $114 per ton, what do you make of it?
Thank you so much, Nigel, for having me here. The deal was almost through 1.5 months back, what I sense, and that's why there was a bit volatility in the stocks. So if you see, on the face of it, this deal looks expensive, but if you look at what Ambuja is going through, I think it makes a lot of sense, because what the company really is facing is clinker shortage. They don't have reserves. ACC has aging plants. They have consumed their limestone reserves for over 60-65 years. What they really need is reserves. So if you look at it, I mean, in terms of reserves, I think it's a fair deal. Yes, expensive, but it's a fair deal. So, and of course, it will give a lot of good plants. I think good plants, efficient plants is a bonus in this case. Had it been any other deal, possibly it would have sounded expensive to me, but not at this current valuation, because they've got good reserves.
Okay, all right. So you're saying that the valuation is on the higher side, but is justifiable because of the kind of asset. Is that correct, Jyoti?
Yes, because Ambuja doesn't have reserves. ACC is a drag in terms of their cost. They need to optimize on their cost, and if they have to achieve a 500 rupee per ton improvement in their cost, they need plants which are proximate to markets and need enough reserves to to make cement and be able to cater to the proximate markets.
Jyoti, you have had your ear on the ground, and me too. The point that could be a deal breaker, so to call it, was this mine in Rajasthan that they have, the limestone mine. And the street was wondering whether or not the acquirer will be able to take that mine. Now, we have the Adani Cement press release, which is saying that they have this mine in Rajasthan and they can add another 6 million tons. So they believe it's doable. Do you think that everything is clear now and they get this mine all clear?
Actually, Orient had the surface right. They were supposed to get surface rights for this mine by FY24 end. I believe this mine would be transferred to them. Should not be a problem. They will get.
So you don't believe it's an issue?
It's not an issue, right? In fact, what really was the issue was the reserves in Telangana, where they were actually looking for forest clearance. I think that is where that was a problem. I think that is resolved, I believe.
So you believe that it will get the regulatory clearance? That will not be a deal breaker now?
Shouldn't be a problem.
Jyoti, I want you to comment on this as well. We recall when Adani Cement went ahead and bought Sanghi Industries, there was this big guidance that was put up, and not all of that has played out. But, because they did that deal with Sanghi Industries and the profitability was limited to some extent. Now, on Orient Cement, they are saying that they expect the ROS to be at around 15%, and they're expecting the EBITDA per ton to go to 1,500 rupees per ton. You buy that? You think that's possible?
So you see, just buying one asset does not provide you with 1,500 rupee per ton. You see, there'll be a lot of changes that would require to be done at the strategic standpoint for Ambuja. Because some plants of ACC which have aged, which have kilns over 80 years, there is a drag in terms of cost. So obviously, achieving 1,500 EBITDA per ton at a console level without closing a few ACC plants will not be possible. You will see those kinds of numbers only by end of FY27 or maybe mid of FY27, once you have completed a consolidation, which I believe should be in the second half. By end of first half of FY26, you will see, I believe you will hear some more acquisitions as well. And the other thing is, Rajasthan results is not coming to you immediately. It will eventually come to you in maybe in 3 quarters time or whatever. So till that time, you still need to optimize on Sanghi. There is some issue on the second line in terms of Sanghi, which they are going through. You know that currently they are stuck with their mines in the south, where I believe the mine in Wadi is closed. There is a struggle in terms of clinker in Karnataka and in some, and also some plant in the east. I think overall has to be a lot of decision strategic changes that needs to be done in terms of optimizing. So immediately 1500 per ton, no, this will come over a period of time, maybe another by end of FI, maybe in the beginning of FY27. You can, this is
That
very much possible to
yeah.
happen.
They're guiding for that, FY27 itself. Jyoti, final question before we let you go. Whenever there is a deal, you have party A doing a deal with party B, but people say, what about party C, D, E, F? Because then they say, this deal is done at around $115 per ton. That asset is available at $50, $60 per ton. And in South, there could be many sellers because profitability of these companies, my rough estimate tells me it'll go down to around 200-300 rupees per ton in this past quarter at best. Some of them could even report a loss. Now you have a big buyer who's bought Orient Cement. Do you think some of them could come to the table? Could there be any potential assets that get gobbled up in the coming months? I believe that, in West India, there could be one asset that could get folded up. I think both of us would understand which that asset could be, which there has been a rumor for a long time. But in South, do you think that one of these assets could get picked up and now it gives you some valuation comfort with them?
Yes, actually, Adani is already in discussion with a couple of assets. We just have to wait and watch which one is going to close down. So yes, and those assets are bleeding. I think what you should look at when Adani is buying, please don't look at the plant and machinery. Even when we used to look at, when we were valuing, we're not looking at plant and machinery, we are looking at the reserves. If you have reserves, which is as good as 50 years or lasts you at least 60, 70 years, is what the valuation. And I think that makes a lot of sense. So be prepared. I believe there are a couple of deals which are going to close by first half of FY26, because 180 million ton that he's saying will also require you to close a few plants in ACC, or rather be replaced by new capacities. So what you're looking at in South, and I also know what was the bids which are being offered. I think it'll be a fair deal as long as you have enough reserves. I think it makes a lot of sense too. We will see a few deals coming up in the next 6-7 months.
Jyoti, it's always such a pleasure listening to you, and you bring such fresh perspective. Prashant here, Nigel, both of you are sharing an inside joke about what is this asset in West. So tell us also what is this asset. But we'll touch upon that.
I think in West, and there'll be one in South as well. But we'll keep it at that.
All right, Jyoti, thank you very much. It's a pleasure. Thank you. Appreciate your time here on CNBC-TV18.